Mutual fund investors inject $2.7 billion into the conventional fund businesses for the week ended February 6, 2013. My name is Tom Rosine. Thanks for joining me today for Lipper's Fund Flows Insight. You know, after we saw some good flows, it was a little bit of a head scratcher. I don't know that we anticipated that we were going to have strong flows into mutual funds again, because we heard some bad news with Spain and Italy. We had some numbers that came out that showed us that the unemployment rate ticked up to 7.9%. And then we also had one of the worst days that the market has seen this year on Monday. However, what's kept people alive and interested in the market is we saw that the Dow went over the 14,000 mark for the first time since November 12th, 2007. So that was an amazing number and it kept people interested. Well, let's see how this panned out into our macro groups. We saw equity funds taking about $4.1 billion. That's a huge amount of money, considering this is the fifth consecutive week that we've seen inflows into that group. That's quite a story on its own. Taxable bond funds saw the merry old way of taking in $3.3 billion. Even muni bond funds, even though it was about $100 million took in money, they were on the positive side, and we saw that money market funds actually shed about $4.9 billion. Not a big shocker there. So if we actually take a little deeper dive and find out what happened in the equity universe, I think we'll be amazed with some of the numbers that came out. Again, the fifth consecutive week that we've seen inflows, again, $4.1 billion into this group. We saw positive returns, about 0.56% return for the week. Again, ended Wednesday, February 6, 2013. But this was the sixth consecutive week that we've seen positive returns. So that's an amazing thing as well. We haven't strung that many together. If we take a look at the 5-week total, we saw about $24.9 billion collected over the last 5 weeks. This is just weekly flows. If we start adding in the monthly flows as well, the number becomes even more phenomenal. This has been the highest amount of money that we've taken in of net new money since about April 12, 2000. Domestic equity funds saw about $1.1 billion in net new money come in, and that group saw their fifth consecutive week of net new money coming into their coffers. Non-domestic equity funds saw about $3 billion of money come into their coffers. And what was really amazing about what happened this week is we saw that the large cap growth funds, again, I should just say large cap as a whole, saw the biggest flows on the domestic side, about $378 million. Nothing to write home about. Remember, these were the pariahs of 2012. And emerging market funds actually took in a whopping $1.8 billion. This was quite a feat. Well, now if we take another side, and this is kind of that tale of two cities of what happened on the equity ETF side, we'll see that they actually took in money for the second week in a row, $1.9 billion. But what's amazing is if we look at the bottom, SPY saw the biggest outflows. About $3 billion exited the coffers of SPY, so that'd be the Spider SP 500. And when we take a look at what brought money in, it was just a little bit of money going into iShares Russell 2000. That's about $700 million of money coming to their coffers. And the iShares Dow Jones United States Real Estate Group Index actually take in about $600 million in net new money. So this is one of those situations where we're taking a look at and seeing that, in fact, there was more exuberance on the domestic side, on the open-end side, whereas on the ETF side, we actually saw kind of a lackluster inflows and the like. So now if we actually go down and take a look at one of the other areas that has just been taking in money, we saw fixed income funds take in money. Now, this is in contrast to what maybe the pundits have been saying recently. They've been saying, wow, we're having a great rotation out of fixed income into equity. We're not seeing it. We're actually seeing money flow into both groups, and we think net new money is actually being put back to work into equities. We saw that basically high yield funds and fixed income funds saw about 14th consecutive week of inflows. $3.3 billion went into this, and for the fifth week in 6, we saw positive returns, about 0.15%. Well, where did the money go? Well, people were looking for yield. They're willing to put a little bit of risk on. They were getting rid of the high yields, but corporate investment grade debt funds took in about $1.4 billion. We saw that that was for the 34th week in a row, by the way. And we saw the flexible portfolio funds actually took in $1.7 billion. This is a big number for them. This is the 7th consecutive week, but even more amazing, when we're taking a look at these numbers, we saw that loan participation funds saw $1.1 billion in net new money coming to their coffers. This is the 34th week in a row that they've taken in money. And the reason they're doing that is they got really good yield, and if we see interest rates start creeping up, they have an adjustment in there. So they really have, if you will, kind of a yield factor that takes into account any sort of inflation. It'll adjust them automatically for us. And by the way, it was the best inflows that we have seen into this group since we started tracking weekly flows in 1992. Well, let's go ahead and take a look at the ETFs. ETFs basically had a very lackluster period of time as far as ETFs go in fixed income. We saw about $1 billion in outflow. The iShare 20-year plus Treasury basically saw $180 million in net new money. We saw the Power Shares senior loan fund. It's kind of a loan participation fund, taking about 160. And at the bottom, high yield bond funds. Again, people were kind of fleeing the high yield factors and get away from them, so that was at the bottom as well. And that brings us to another story that's been just starting to heat up again, and that's muni bond funds. For the 6 week and 7, we saw that they had plus side performance, only a 0.22% return, but we saw for the 6 consecutive week flows into them only about $100 million, with national munis taking in about $95 million of that. So really that was the majority of the change that came into muni bond funds, as people are still looking for the advantage of higher yields on a tax-adjusted basis. Well, that brings us now to money market funds. And we really haven't had a solid story about money market funds. $4.9 billion were shed from that group. Not a big amount of money. And this is one of the areas that we were kind of saying, we don't think that people are pulling money out of either fixed income or money markets to put it back to work in equities. They're actually coming off the sidelines and putting money back to work. That's what we're seeing from these flows numbers. Again, $4.9 billion in money market funds exited the business. This is the third week in floor that we've seen outflows. And when we break it down, we see taxable money market funds lost about $5.7 billion, with tax-exempt money market funds taking in about $0.8 billion. And how we break out the taxable money market funds, institutional investors actually withdrew about $5.5 billion, while the average retail investor only took out about $0.2 billion. So not a big story there, other than we see from these flows that people are putting money back to work from other investment choices. Maybe it's their bank accounts, maybe it is their 401ks or whatever that are just being recently funded. So maybe it's just new money entering the market, but in any case, it's not coming out of other funds or fixed income or money markets for that matter, that's being put back to work on the equity markets. Well, as we go forward, here's where the concerns are going to be. Obviously, earnings and guidance has been very strong, with about 59% of the universe reporting on the S&P 500. We see that 69% have beat expectations. Hopefully that'll continue on, and if it does, we expect that we'll see continued inflows into equity funds. But one of the things that came out yesterday was we saw non-farm productivity actually decline 2% on an annual basis, which was one of the biggest declines that we've seen in some time. And this may shed a little concern on the rally going forward. So we won't know obviously till the flows start coming in for the next week, and you can join us next week as well, or you can go online to lipperusfundflows.com and take a look at the classifications that you would like to take a deeper dive on. Well, until next time, my name is Tom Rosine, wishing you the best in your wealth planning and creation.